On today's episode, we're going to talk about a concept called the three investment worlds. Now, I've been talking about this for years. All of our advisors here at the Elevator Retirement Group talk about it. All of our university educational classes we teach all over the city and online. It's really a foundational educational piece that I think everyone needs to understand about what their choices are when it comes to where to put their money to make money in retirement, especially. Welcome to Your Retirement Elevated. I'm Scott Dugan. And for the last 25 years, my team and I have been helping guide people to and through retirement. And what we're going to talk about today is the three investment worlds is a foundational piece that we talk about at the firm that once people see it, we go through it, it really gives them clarity on what their choices are when it comes to putting money away for retirement. And so our first world we're going to start with is really the world of protection and savings. And this is really going to be focused on safety. And so in this world, you've got three basic institutions that live inside this world. The first is going to be your banks. Now, we're all going to need a relationship with a bank because that's going to be our, checking accounts, savings accounts, CDs, things like that. And what we're looking for here is safety. We want to put our money there. We want it to be liquid, and we want that bank to hang on and take care of it for us. Now, the second entity would be the government. That's where we buy treasuries because the full faith and credit of the United States government, as long as they're solvent, you put money there and it is safe. And the third entity is going to be an insurance company. And that's where a specific type of annuity comes into play called a fixed annuity. Now, we've had other episodes that talked about all different types of annuities, but this is going to be where you put your money with an insurance company. They're going to sign up to say, we're going to hold it for a period of time, let's say 1, 3, or 5 years or longer, and we're going to pay you a guaranteed interest rate for that time. Into that period, you get your money back. All right. So those are the three major categories of safe vehicles inside the world of protection and savings. Now, the foundation of the world of protection / savings is your principal is going to be guaranteed or backed up by the institution that's holding your money. Number two, your interest is going to be guaranteed for that term. And number three, there's going to be some sort of penalty if you take the money out early. So think about a CD. If you put your money in a 5-year CD and 3 years in, you say, hey, you know what? I need that money back. Well, the bank made decisions based on a 5-year period. So if you take that money out, they're going to take some of the interest away as a penalty for breaking that timed deposit. So again, we always are probably going to need some money in this quadrant or in this world, that's going to have safety, liquidity, and some sort of guaranteed growth rate. Now, on the opposite end of the spectrum is the world of potential or investments. That's where we're really focused on growth in three major categories for today's purposes. That's where you're going to find mutual fund companies and mutual funds. Or you have ETF funds that are out there. You're going to have brokerage houses, the big brokerage houses that are out there. They're going to sell you stocks, bonds, ETFs, index funds, alternatives, all different types of investments that you're going to seek growth from. And then you're going to see insurance companies show up again. And that's where they're going to offer something called a variable annuity. And a variable annuity is really mutual funds inside of an insurance wrapper. Now, if you've been watching this show for a while, you know that we can be critical of a lot of investments. One of them that we pay close attention to is the variable annuity. People think about annuities. There's a lot of qualities of the variable annuity that people actually put across almost all different annuities. And that's thinking, hey, these are high-end fees. And that can be true with variable annuities. Not with the fixed annuities we talked about earlier. There's no fees there, but a variable annuity can be chocked full of fees. And I've seen them anywhere from 3 to 5% annually fees that are charged against them. So be very, very careful. And the devil's in the detail when it comes to variable annuities. And in our opinion at our firm, if you're going to be in the market, you're going to buy those funds, buy them outside of that insurance wrapper. This is a very specific reason to do that. Now, what's underpinning that is, principal is not going to be guaranteed in these investments or in these instruments. Number two, their growth is not going to be guaranteed. That's why there's risk that's involved. And number three, you need time to be on your side. Why? Because those investments can move up and move down. And depending on the amount of risk you're taking, that could be a very wide stance or a very wide bracket of up and down. And so we're looking at these, we're probably always going to need some money in that world of growth. And because we need to keep up taxes and inflation, we know over time the markets do produce. But you have to have good timing and need to know when you can be able to access those dollars. Now, that third world of investments is really a bridge between the world of protection and the world of potential. And where you see this show up, and you hear a lot about it, insurance companies are here again. And this is where you're going to have certain types of hybrid annuities or indexed type of annuities. And what they've done is they've taken some of the foundational things of the world of protection, which your principal is going to be guaranteed, there's going to be a guaranteed interest rate, and there's going to be some sort of penalty for early withdrawal. So you've got a floor underneath the money, but how are we going to grow it in a respectable manner? Well, that's where we take and tie it to the world of potential, where we're going to have some sort of index where they're basically buying call options. When the market is up, we get a percentage of the gain. When the market's down, we don't lose any dollars. Now, some people say, well, that sounds too good to be true. Again, they're just buying call options at the institutional level. And again, if the market's up, we're going to make some sort of gain, not all of it. Market's down, that call option is worthless. We get a zero and we start over the next year. And really, insurance carriers have tried to make this attractive for this retirement generation. And I would tell you, if you put 10 of these type of accounts on my desk, I probably wouldn't like 7, 8, or 8 of them. Because again, the devil's in the detail, just like the variable annuity. But this is probably one of the most popular annuities going. And again, they're not right for everyone. This is not a magic bullet. This can be a part of someone's plan, depending on their risk tolerance, what they're trying to accomplish, and a lot of factors that go into it. So we don't have a cookie cutter approach. Now, we're not afraid to talk about them, but we also need to talk about all of these investment worlds have strings that are attached. And we're making these choices on how to build a plan. We need to understand all the strings and to make sure that the benefits that come along with those strings, are they worth it? So we may have one family that comes in and they say, you know what, we are very comfortable with the markets. We're going to keep cash over here in the bank. We're going to have our checking account and a savings account. And then the rest of it's going to be all in the market, both fixed income and equities. Fantastic. We build plans for those folks. We have other people on the opposite end of the spectrum say, you know what, we're very risk adverse. We have a lot of guarantees that are there, and we're going to look at banks, we're going to look at treasuries, and we may look at some sort of insurance product or annuity that's applicable to their situation. But always know when we're going into this, if someone is going to use this kind of world of protection, we're always trying to get the smallest amount possible to do the right job. So again, when you go through these, again, some of these may be in your plan, some of them may not. It depends on what you're trying to accomplish. And the last takeaway, and this is very important to understand, is that when we're trying to get a better return, there's 2 ways to increase our upside potential. The first way is to go from a world of safety to a world of growth. If you think about it, your checking account is what? It's safe, it's liquid, it's going to have an outcome. Now, we've had decent interest rates for the past little bit, but where are interest rates headed? They're probably headed down. Now, if we want to make a higher return, we need to take on more risk. And the higher the risk, the higher the potential return. So that's the first way that we can make more growth. The second way is to go from a situation of liquidity to a longer term. And so if you think about the example of a checking account, how much interest does that pay? Well, not a lot, because the term is what? It's liquid all the time. A 1-year CD doesn't pay as well as a 5-year CD. Why? The term is longer. The money is going to be committed to a longer period of time. So you should be rewarded. Now, there's times where that's inverted, but for the most part, if there's a longer term, then you should be rewarded with a higher upside potential. And that really that's applicable to the world of protection. It's in the hybrid section. And when you look at alternative investments, those have a term to them as well, because those firms need to know they can hold on to that money for a period of time to let the investment grow. So as we wrap it up today, I hope that you have a better understanding of what your choices are. And again, everyone's going to be different and what money shows up in each of these. But as long as you understand, there are no perfect solutions. There's only compromises. And each of these worlds has its set of strings attached, has a set of compromises, but they also have certain benefits that may apply to you and may get you to where you want to go in your retirement. So thanks for watching today. We'll see you on the next episode.
Are you on the path to retirement but feel uncertain about your direction? Don't let myths and misconceptions cloud your journey. Before stepping into a lengthy retirement, gain clarity and confidence with a complimentary financial review. Schedule a conversation with Scott Dugan. It's completely free. Just click the link in the description below or call us at 913-393-4724. Let's start a conversation about what's most important to you as you plan for a successful retirement.
This podcast has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this podcast is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt, Mark Killian, and Third Wheel Media LLC are not clients of Elevated Capital Advisors. They receive cash compensation for their assistance in preparing and hosting this podcast, and for providing the endorsement contained in this podcast. Because Walter, Mark, and Third Wheel Media are compensated in connection with this podcast, they have a material conflict of interest in providing their endorsement.